All right, let's talk honestly. For months, we've all heard the same thing. The market is manipulated. It's only the Magnificent Seven holding everything up. If you remove those stocks, the index collapses. And now those same stocks are pulling back. Capital is rotating, the concentration is easing, and suddenly the narrative changes. Why? Because when a stock in your portfolio drops 40%, 50%, sometimes even more, it stops being theory. It becomes physical. You feel it in your stomach. It's stress. It's doubt. And that voice starts whispering, "Did I get everything wrong?" Let's start right there, because I'm in this situation too. There are positions in my portfolio down more than 50%. That's not noise. That's real money. Take Robinhood, for example. I like the company. In my wheel strategy portfolio, my average is around $18. Recently, it touched 17. That gap hurts. Even if you manage the position with options, even if you didn't buy the absolute top, watching value drop is painful. But here's the key. This is not 2008. This is not a systemic collapse. This is not the financial system breaking. This is selective rotation. And if you understand that, you don't just protect your capital, you protect your peace of mind. Now, before we go deeper, quick housekeeping. Nothing I say here is financial advice. I'm sharing my journey, my reasoning, my framework. Investing involves risk. Never follow anyone blindly, and not me, not anyone on YouTube. Study, think, decide. Also important, I do not use Telegram for business. If someone contacts you pretending to be me, it's a scam. Block them immediately. Okay, let's get to the real substance. Why is capital rotating right now? Every rotation is driven by three things: interest rates, earnings expectations, valuations. For years, we lived in a world of ultra-low rates, liquidity everywhere, multiples expanding. Investors were paying today for profits expected 10 years from now. But when rates stay higher for longer, something very simple happens. The present value of future earnings drops. This isn't about whether a company is good or bad. It's math. Let's say you have an amazing company growing 18% per year. In an euphoric market, investors pay 35 times earnings. Then the environment changes. Rates rise. Risk-free returns are higher. Suddenly, the market decides that company deserves 20 times earnings instead. The business didn't change. The product didn't change. The growth didn't change. But the stock might fall 40 or 50%. That's valuation compression. We have to separate business destruction from multiple compression. If the engine is still producing profits and free cash flow, price eventually follows fundamentals. In the short term, the market is a voting machine. In the long term, it's a weighing machine. Right now, I'm down on positions like SoFi, Robinhood, Palantir. But unless the fundamentals break, a red number on the screen is not the same as permanent loss. Now the big question, if money is leaving growth, where is it going? It's not disappearing. Look at defensive sectors. Walmart, Coca-Cola, Pepsi. Why are they holding up? Because people keep buying essentials. They have pricing power. Cash flow is stable. In uncertain phases, the market rewards predictability. But the most interesting shift is inside AI. We heard about the software apocalypse. Some SaaS names got hit hard. People said AI would destroy traditional software. But capital didn't abandon AI. It changed exposure. Look at companies tied to physical infrastructure, storage, data centers, cooling systems, energy support. AI needs hardware. It needs massive infrastructure. So we're moving from narrative, AI will change everything, to monetization. Who gets paid to build it? That's not collapse. That's maturation. Now let's address the elephant in the room, the Magnificent Seven. Yes, even they are seeing profit-taking. There's concern about how much they're spending on AI. CapEx is huge. When companies spend aggressively, margins can compress in the short term. But remember something. For months, people complained that the market was unhealthy because only 7 stocks were leading. Now participation is widening. That's healthy. A broader market is a stronger market. It builds the base for the next cycle. Now let's get personal. What does this mean if you're staring at a position down 50%? Here's the uncomfortable truth. Not every stock will recover. Some won't. That's reality. But companies with real competitive advantages, strong balance sheets, real growth, historically, tend to surpass previous highs over time, because intrinsic value grows. Since 1950, the S&P 500 has averaged around 10% per year. Through wars, recessions, inflation, crises, the long-term trajectory has always been upward. If we were in systemic collapse, you'd see credit markets freezing, liquidity evaporating. That's not what we're seeing. We're seeing redistribution. And your real edge right now isn't secret information. It's calmness. If you sell quality during fear, you're transferring wealth to someone else. Wealth is rarely built during euphoria. It's built during uncomfortable phases managed with discipline. If you don't have cash to buy the dip, don't panic. The lesson you're learning right now is worth more than any single trade. Emotional resilience compounds just like capital, and this is the part nobody talks about. Emotional resilience is the price of financial freedom. You don't just need capital. You need the psychological strength to endure volatility without self-sabotage. So here's your checklist. Number 1. Actually, let's just get to the points. Number 1. Review the thesis, not the price. Has the business changed? If yes, reassess. If no, stay disciplined. Number 2. Look at free cash flow and debt. Balance sheets matter. Number 3. Extend your time horizon. If you need the money next month, you shouldn't be in volatile equities. Number 4. Accumulate gradually, not emotionally, not impulsively. This phase is not the end. It's a filter. Capital is selecting, and in the long run, quality tends to win. If you're investing money you don't need for rent or food, what you need now is patience, not panic. The goal isn't to win this week. The goal is to build a system that makes you financially independent and creates generational wealth. I'm here with you, in green days and red days. Let me know in the comments how you're handling this rotation. And remember, the best is still ahead.